Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. We do not have Brian Lunton today, but he will be on the interlude with our regular CEO interview. I am fortunate to have Yvo Timmermans, CFA, a portfolio manager at JLP Asset Management. He focuses on global real estate securities and has 14 years experience. But he came to my attention because of a wonderful article with the CFA Institute blog, Enterprising Investor. And if you follow my Twitter, you would have seen me promote that. And the headline is Gold $3,000 question mark. What a juicy headline. Welcome to the show, Yvo.
Thank you very much. Thank you for having me.
And just give people, I guess, the quick and dirty summary. It's not that gold is going to 3,000, but you came up with basically a confidence interval based on simple regression. What was that regression and what was the interval? Do you want to summarize your conclusions?
Yeah, so what we did is we went back for 40 years. Eventually, the data goes back to 1981, and we use quarterly data. And what we did is we used, as you already mentioned, we used simple regression, econometric analysis, and we demonstrated that a 1% increase in the DXY, and the DXY is basically a measure of dollar strength against a basket of currencies, mainly the euro, which represents 60% of that basket, what a 1% increase in the DXY would do to the price of gold. And the analysis shows that the price of gold would fall by 67 basis points. Equally, and I think this is very important right now because of all the money printing that's going on, we measure and we demonstrate that a 1% increase in the money stock ratio, so that's M2 divided by GDP, what kind of impact that has on the real price of gold. And we show that gold would actually rise by 2.77%. Then we discussed three different scenarios. One is the first scenario shows that there is no change in fundamentals. And what that, no change in fundamentals would basically mean that gold would remain at current levels. Let's say right now it's trading just sub 1,800. It will be trading in the current range up to $2,000 an ounce. Then we have a second scenario where there is continued monetary expansion. And this would suggest that gold would actually increase to $2,400 by the end of the year. And then a third scenario assumes that the DXY would fall to the level last seen in 2008, just prior to the collapse of Lehman Brothers, when the dollar hit actually 160 against the euro. And in that case, the gold would actually rise to $3,000. I think now, given recent events where the US dollar decline has seemed to come to a halt, at least for now, temporarily, and I think that it's partly related to the fact that Europe has been mishandling the vaccine rollout, and the US has actually done a much better job at that. I think it's very unlikely that we're going to see $3,000 by the end of the year, and it might actually also be unlikely that we're going to see $2,400 by the end of the year. And I think there are several reasons for that. I think we might be able to go into that. I think there's, on the one end, I think central bank policy in Europe has changed over the last couple of years. It's much more accommodative than before. Before it was much more led by the Bundesbank, so fiscal hawks. The ECB kind of abandoned that. So I think that's one of the reasons. Another reason could be, but it needs further research, that cryptocurrencies, and in particular Bitcoin, is actually taking market share from gold as a new gold 2.0. That's the theory. That's something that's beyond the scope of this particular article. But what we do believe, and I think this is critical, I think what's really important is what is the message that these high gold prices and other financial asset prices are sending to the markets. I think the general consensus view is that there hasn't been any inflation over the past decade or two, at least if you measure inflation by conventional measures like CPI, consumer price inflation. But if you look at financial asset price inflation, for example, equities, bonds, whether that's sovereign bonds, corporate bonds, whether that's high yield debt, real estate, venture capital, private equity valuations, cryptos, basically all financial assets are trading at record high levels. And I think zero interest rate policies is one explanation. I think another factor, obviously, is the tremendous amount of money printing that's going on. Helicopter money, basically money being printed and handed out to people, which is what's literally happening in countries like the US, like Brazil as well, during the pandemic. And I think that's worrying, because I think the dispersion, or let's say the wealth gap between the affluent part of society and let's say the poorer part of society is growing.
Working class,
exactly. Working class part of the society is growing. Middle class is eroding, and I think that's problematic. And I think that's also what you're seeing in politics, with a lot of polarization in elections, a lot of polarization in politics, and also the growing importance of capital and technology over labor. That also exacerbates this problem. If you take a look at the Gini coefficient in the US, for example, it's right now, I think, in the mid 40s. And it's approaching levels of some emerging markets. So I think that's to me is actually a very worrying development right now.
Yeah, there's so much you said there, Yvo, to pick apart. Now, let's just in terms of clarifying the original research and regression, you focused on two ingredients. One is the relative strength of the US dollar, and there being an inverse relationship, i.e. the stronger the US dollar, the weaker the price of gold.
Correct.
And then also monetary expansion. So again, inverse, more monetary expansion. Oh, no, sorry, that would be not inverse, but a positive correlation. More monetary printing, higher US gold price. And you came up with three basic outcomes or scenarios: $2,000, $2,400, $3,000 for the end of the year. And this article came out, I'm guessing, a few weeks ago now. So there have been some new developments.
Yeah.
And one thing about this, it wasn't that you just said, oh, these are the presumed relationships. You actually really quantified them. Now, were you surprised by how large or small those relationships were?
I think we were surprised by the if you take a look at the DXY impact on the dollar on gold. I think we were not so surprised. I do think that the money stock ratio to GDP, what came out there was 2.77%. So every 1% increase in the money stock ratio would increase the price of gold by 2.77%. That's in real terms, right? So that's in real terms. I think that was very, I think that was definitely very surprising. I'd expected it to be much less, to be honest. And it is quite shocking, given the fact that a lot of central banks, Fed is printing like there is no tomorrow. The ECB, maybe to a lesser extent, but it's very actively monetizing debt. And I think maybe it doesn't materialize within this year, but I think longer term, and we've proven that longer term, this relationship actually holds. So maybe that 3,000 price target, let me put it that way, for the third scenario that we highlighted in the article, maybe that's something that might happen next year or in 3 years from now. It never happens, it never goes linear. There's always sometimes there is some undershooting, and sometimes there's some overshooting. Right now we're undershooting because the price of gold is actually below 2,000. But our analysis shows that it should eventually catch up unless some development occurs that would break that relationship.
Yeah, as you said, there was a striking, it wasn't just a trivial amount, it was a serious amount, and you said in real terms. And this was not a shot in the pan. It was over almost 40 years of data. So a serious period of time to build up, the relationship or the regression. And let's just so people don't get confused, and for my own sake, to be frank, I read this article a little while ago, but the 1% change to the index and then a 1% change to the monetary supply. Do you want to clarify what the data was, if you can dig down a little bit into the ingredients there?
Yeah, sure. So M2 is basically, M2 is money supply, and then GDP. So we used for the price of gold, we used a deflated base. So that's the real term the real price growth that I was just referring to. And eventually, if you assume 2% or 3% inflation, you can kind of back out what the price of gold would have been or would be by the end of 2021 if you assume 2 to 3% inflation. And then M2 is basically based on the current monetary expansion that we're seeing by the Fed, and that's the Fed only. So not what it doesn't take into account any other central banks. So this is just the U.S. central bank, and so we combined it together in the regression analysis. And then the first scenario is basically no change in fundamentals, so it doesn't really matter. But the second scenario focuses really just on monetary expansion, so it doesn't take into account any weaker dollar scenario. It's just monetary expansion. And then the third scenario talks about what if you include a scenario where the US dollar eventually will fall back to the level last seen in 2008. So that would be 160 against the euro. Right now it's 121. So that would mean a very significant depreciation of the US dollar against the euro. So I think, and the euro obviously being 60% of the DXY index.
Yes.
It's the other currencies. There are always other elements, and that's what we show also in the regression, that there's a certain part that's not explained by the regression, and you always have that. A regression never explains 100% of the analysis.
Yeah, you're only using two ingredients too, so to expect it to explain everything would be a bit,
exactly
too much. And I should note, you were in Amsterdam in the Netherlands. And you co-wrote this with Paul van den Noord of the University of Amsterdam. So we have a bit of a different perspective there. And we have been discussing cryptocurrencies a lot on this show. It's just, I guess, talk of the town. And in particular, we have examined whether cryptocurrencies, specifically Bitcoin, can divert some of this interest in getting out of the dollar. And you said you haven't yet really dug deep into this, but you have a sense that actually it is diverting interest.
Well, yeah, I think I'm not a crypto expert and not a Bitcoin expert, so it's hard for me to make any let's say, very deep comments about this. But what I do think is that, especially if you look at the fact that Bitcoin is becoming increasingly institutionalized. So the rally in, when was it, 2017 or 2018, was mainly driven by retail money, mostly out of Asia. Right now, you're seeing it's becoming increasingly institutionalized. Even corporates are using it. Pension funds are adding it or considering to add it. So I think that on itself is a very interesting phenomenon. Banks might be considering using it as well. So I think you could make a case that maybe some of that interest that would usually go to gold is actually being diverted, and it's going into what I'd say would be gold 2.0, in this case Bitcoin, and that could be an interesting field of study going forward. If you look at, for example, Bitcoin and the trend of cryptocurrencies at the beginning of these years that have been surging again, whilst the price of gold obviously sold off a little bit. And maybe in the future it's going to be one of the new world reserve. I wouldn't call it an asset, but it could be a replacement of gold to some extent.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, I'm Brian London, and I'm here with our CEO interview of the week. Here we have Cameron Timstra, CEO of Tarachi Gold Corp, symbol TRG on the Canadian Stock Exchange. Tarachi is part of the Inventa Capital Corp group, which is the sponsor of the Gold Newsletter podcast. Very excited to have Cameron with us today because this is a story I'm just discovering. It is kind of a new story to the market, but very exciting, and has been welcomed to the market with open arms by some very smart investors, still very undervalued from what I can see so far. It's a kind of a two-pronged approach or business model. One is high-grade gold exploration, but also very early cash flow, insignificant cash flow through a tailings operation. Cameron, can you kind of bring us up to speed on that two-pronged business model and the recent news that you have on closing some important acquisitions and some good drill results?
Thank you, Brian. Yeah, I mean, you really hit the nail on the head calling this sort of a two-pronged approach to the company. What we want to do is keep our shareholders exposed to that upside blue sky potential of a highly prospective high-grade gold exploration project. That's our Tarachi project located in Sonora, Mexico. And then on the other side, we have the Magistral tailings reprocessing facility in the Durango state that we expect to be generating cash flow as early as next year from that. And our plan is really to deploy that cash flow from Magistral to explore on Tarachi and potentially even to acquire other properties in Mexico. That way we can keep ourselves exposed to that upside while at the same time minimizing our risk to shareholders for that future shareholder dilution, which we've seen so many times over, hundreds of times over in this industry, in terms of companies raising money every 6 months or 12 months to drill holes. And then if they get a few misses on the drill holes and the stock price goes down just in time when they need to raise money, makes it very difficult. So we're really excited to have this new asset. We just signed the purchase agreements about 2 weeks ago for Magistral while we were down in Mexico. We went down there and looked at the facility. This purchase agreement basically comes with a facility that was custom made to reprocess tailings. It was originally built as a carbon and leach system, but has since been modified to a Merrill-Crowe system. And in addition to the facility, we have access to about 1.3 million tons of tailings at a grade of about 2 grams per ton, or just over 2 grams per ton. So this is really a high-grade tailings deposit. A lot of tailings you see are typically 1 gram or less. So we're really excited with this. These tailings were generated over the course of hundreds of years, originally with mercury amalgamation and eventually flotation. So they've never seen the use of cyanide before. So we're pretty confident that we can get sort of 70+% gold recoveries from there. A full production of about 1,000 tons per day. We'd anticipate generating about 1,400 ounces of gold per month, or about 15,000 ounces of gold per year for a period of about 4 years. And that's going to buy a lot of drill holes at Tarachi or elsewhere in Mexico. And so we're very excited to have that in the company.
Yeah, from what I can see, the investor enthusiasm in the company so far has been largely revolving around that tailings project. That grade is really remarkable, as you mentioned. That's about double the average open pit mining grade, and yet you don't have to dig it out of the ground. And you have the facility, the processing facilities right there. So the economics of a large-scale tailings project, because you don't have to dig it out of the ground and it's just kind of sitting there, are typically extraordinary. But in your case, with double the grade, the facility already built, it seems like those numbers are really going to tumble well for you. I know you don't have those numbers out yet, but you're developing a PEA that will kind of show the market exactly or more closely put pen to paper and show what those numbers are likely to be.
Yeah, that's right. We plan on engaging Ausenco Engineering to complete a PEA pretty much immediately. We expect that to take about 12 to 14 weeks. So perhaps by the end of May, we should have something there that will provide us with both a 43-101 compliant resource for the actual tailings, since we only have historic estimates right now. It'll also provide us more detail on what we want the final flow sheet to be. We do expect to make probably some modifications to the existing facility to maximize gold recoveries and keep cyanide consumption down and costs down as well. And that's also going to help provide the market with a much clearer understanding of what sort of capital we need to invest to get it to a steady state for commissioning, as well as what sort of timelines to expect. Right now, we expect to be commissioning the plant probably early next year. Not early, because this facility was at one point also permitted as well. There's a tailings disposal facility there that is going to need a little bit of work to get it up to standard, but we're pretty confident that we can accomplish those things in a pretty short period of time. And this PEA work that we're doing with Ausenco will help nail down some of those timelines and those costs and provide the market a little more of a firmer picture of what the project's going to look like in terms of economics.
Yeah, and when you invest in a junior mining company or a junior exploration company, you always look for those important upcoming catalysts. And I would think that would be one there, because the market, it would be very clear to the market how to value the company, because you're talking about near-term production. So it's simply doing the math to come up with NPVs or a multiple of what your anticipated earnings are. So that's the opportunity, I think, for a near-term re-rating of the company. You also have some interesting drill results out, and I found them interesting because you kind of explain how the first drill results, while you got some high-grade results, they are contributing to a new understanding of the mineralization, perhaps higher grade, more steeply dipping structures, perhaps associated with pressure pipes. Can you explain what you're discovering there and the implications for the future?
Yeah, so our Tarachi exploration project, we kind of divide into two sections. We call Tarachi North and Tarachi South. So the Tarachi North claims are sort of northwest of Agnico Eagle's La India mine. We've been drilling on what we call the San Javier concession. So that's where those 9 holes that we released from Tarachi North earlier this week are from that area. There's been some historic drilling in that area with high grades of up to sort of an ounce per ton over a couple of meters. So we were following up in those mineralized areas. And what we found in our recent drilling is that there's actually sort of an intrusive breccia pipe system there. And it appears that the higher grade mineralization may be along the footwall of those mineralized breccias. And then actually there seems to be a trend of breccias in that area as well. If we go sort of southwest off of our claim, there's several other of these breccia pipes that have actually been mined artisanally in the past underground, where they are extracting ore sort of in the 5 to 10 gram per ton range, which is kind of what we're seeing in the upper regions of the breccia pipe system that we've just drilled. So the next round of drilling that we have planned is actually to go back there and follow up on those great drill results and target the deeper extension of this system and see what might lie below, typically where you're going to find finer grain pyrite and typically higher grade gold grades as well.
Well, Cameron, thank you for this brief review summary of the story for Tarachi Gold. It seems to me, just looking at it, that you're probably, it's an early stage company. You really haven't gotten the high market profile. This is kind of the thing we look for, is finding these early stage opportunities. It looks like you're about fairly valued to me for an early stage exploration play, considering the high grade gold targets you have, but likely, in my opinion, severely undervalued for your gold production coming up. So really an exciting opportunity for those who can take advantage of this early stage and get in before you get more widely known and and before that PA comes out, and the market knows very certainly what your value should be. So Cameron, thanks so much for joining us today and giving us this overview of Tarachi Gold Corp, and we look forward to seeing updates in the future.
Thank you, Brian. I appreciate for you having me on the show today.
Yeah, we actually, my own team, one of the ladies who works with me, is an article making this very point. It's not been published yet, but it's basically how Bitcoin can become a reserve currency and how the technology is evolving to make that the case. So it has obviously first mover advantage.
Does.
Yeah. And one thing actually, just to before we move on from this price projection work, the one of the most optimistic outcomes from this research is that basically it's all upward. You know, that right now, what is it, 1800 and something? I didn't look this morning.
1770.
Okay, so we've gone a bit down. So basically, the projection, even in your lowest no change scenario, is still getting to $2,000. So there's only upward movement. And does that just, why is the market at this point not taken the Yvo Timmermans view of the world?
Yeah, I think there are so many views out there on gold and on just in general on any asset class, whether that's bond, equities, cryptos, or gold. So I'm just one person that writes an article with another guy. So it's just an opinion based on research we did. I think right now, I think it's too short notice to say that this scenario is not going to unfold. As I mentioned earlier, it's never going to be a linear road. It's always, prices fluctuate. But I think it would be interesting to look back maybe in a year from now or 2 years from now and see how things have developed. Because then I think you can also retest some of the assumptions you made. You can run the regression analysis again. Also see how much, what the R2 is, for example, how much is actually explained by the regression we've done. Yes. So I think right now it's too early to tell that, because today the price of gold is 70.70, and we're actually outlining 3 scenarios at 2,000, 2,400, and 3,000. They're all significantly above. I think we should look back in a year from now, in 2 years from now, and see where the price of gold ends up. So I think I think it's just too early. Bear in mind though that this article was written. So we sent it to the CIVA Institute, I think by the end of summer, but it was published. It always takes a while before it gets published. So I think it was like 4 or 5 months.
Oh, wow.
Yeah.
Okay. Yeah. So they really sat on that for a while. Yeah. As you say, we're so early. This is still February. It's so early in the year that saying whether your projections were right or wrong is premature. And you mentioned high asset prices as something you just think as relevant. And when you say high, you're just referring to certain ratios that you see as out of hand?
Yeah, I think sovereign bond markets, or just generally bond markets, I think is the best example. How is it possible that some European countries that are in financially very bad shape can issue debt at negative rates? Obviously rates in a lot of countries right now are zero or even negative. But if you look at that, it doesn't make a whole lot of sense. I think for me, that's the biggest bubble out there, sovereign debt markets. And eventually central banks will do everything within their power to prevent those sovereign debt markets from imploding, because they will lose their jobs. But I do think that in order to do that, I don't think there is enough capital out there to just keep on buying this debt. So you need to monetize it. And I think if you keep on monetizing the debt, all that sovereign debt, eventually fiat money will take the brunt. So eventually, I think that's what we have been seeing, is that the price, the dollar or the euro, will eventually lose value against other asset prices, like real estate, like gold, for example. That's exactly what the article is suggesting as well, or potentially even cryptocurrencies. But I think if you look at ratios, I think just looking at the debt markets, there are companies issuing debt at 0% for on a 5-year basis. In my point of view, I think that sounds very unhealthy. And I think even bad projects get funding right now because there's just too much capital. There's just too much money flowing around. If you look at share price, at equity prices, I think it depends really on which sector you're looking at and which country you're looking at. Maybe tech stocks look a bit toppy. I think there are sectors, other sectors, for example, I'm always looking at real estate stocks, for real estate securities, REITs. There are a lot of them that are actually trading significantly below the underlying asset values, that below pricing in that we're seeing in private markets.
Yeah, below the NAV. Why would that be?
Exactly. Yeah, net asset value. So we're seeing transactions, for example, happening at let's say book value, or even premiums to book value, but the shares are trading at 20, 30, sometimes 40% discounts. So that's, I think that's where I think there is actually some value. But I think other asset classes like private equity valuations, venture capital valuations, I think a lot of that, at least on the PE side, is debt driven. So if debt markets were to correct or were to implode, and eventually credit leads equity and not the other way around, then you should see, I think, a dramatic correction in prices.
Yeah, that's interesting. You mentioned there are opportunities there in real estate. It's counterintuitive. Okay, and you said you believe the financial. This is before we started recording. You mentioned that the financial system, I assume you're referring more to the European and American markets, is broken and needs a reset. What reset? Well, just actually regarding your comment about these buying of very low interest paying bonds. Well, that's the market rate for them. My understanding is that, especially in European countries, this is largely driven by regulatory imposition. That basically firms, pension plans are mandated to hold these bonds.
That's correct.
Yeah. Do you want to clarify that? What's going on there?
Yeah, I think that's absolutely correct. That's definitely driven by the regulatory framework, and that's related to risk ratios. So, for example, government bonds get, basically carry zero risk, whilst other, which is interesting.
Yeah. Not if you look at history, but sure, yeah.
Exactly, and especially in Europe, because European countries cannot issue their own debt, their own currency, because we gave up that right. After the basically in Holland we had the guilder, in Germany they had the mark. In Italy, the Italians had the lira. So as soon as the euro project started, obviously you give up your sovereign, I'll call it right or whatever, your sovereign right to issue currency. So right now there is no European country within the eurozone that actually can issue, their own currency. That's up to that's not up to them. But going back to your point about that it's related to actually regulations. It's true that for example, sovereign debt carry zero risk weights, whilst other, for example, corporate debt or high yield debt or equities have a different risk weighting. So automatically, I think that's it's very smart of politicians, because on the one hand that means that they create a way to finance their deficits, because they know that pension funds and insurance funds will eventually have to allocate to sovereign debt, because that's what the regulatory environment mandates them to do. But frankly speaking, I think I personally see sovereign debt in Europe, but probably also in other countries as quite a risky investment right now. And why would you want to be in there if if 10-year sovereigns are yielding 20 or 30 bips negative? I mean, how much more upside do you have from that level? I don't have the answer. I don't pretend to have the answer, but just intuitively, it feels that there is not a whole lot more upside there.
Yeah. In this discussion of the need for a reset of a broken financial system, what reset do you have in mind?
It's not necessarily that I have a certain reset in mind, but obviously we used to have a monetary system that was pegged to gold. Right now, we don't have such thing, but you could imagine if central banks keep on printing at the speed they're doing right now, I think eventually people will keep on questioning more and more the value of fiat money. And I just wonder what the longer term implications would be. And maybe to your earlier point about Bitcoin being, for example, a world reserve currency, or maybe the renminbi would become a world reserve currency. Those are all possibilities. Right now, that's not possible. The latter is not possible because China, it's still very much a closed economy, closed capital account, and not a freely traded currency. But longer term, you could see something develop where maybe the US dollar would lose its world reserve currency status, and that would be replaced by either the renminbi or something else, or maybe a combination of currencies. But I think history suggests that whenever a reset happens, that never goes unnoticed. Usually, that means that somewhere, somehow, something will blow up, whether that's a currency, a country, or debt markets.
Yeah. So basically, you just foresee the prospect of a lack of confidence in these fiat currencies or central bank currencies, and in some ways, they are killing the goose that lays the golden eggs because they're so useful to them, as you said, as a debt debt facilitator for governments. Okay, there's a lot going on there, and I just, as I said, I really like the clean or simple article from you. We'll have it on the show notes. It's just goldnewsletter.com/podcast. Folks, if you haven't already, please subscribe and even turn on notifications on YouTube, SoundCloud, wherever you're listening. Otherwise, Yvo, people should be following you on LinkedIn, and I assume, are you on Twitter?
I'm not yet on Twitter. I probably will be soon, but I am on LinkedIn, yes.
Okay, follow Yvo on LinkedIn. We'll have a link to that also. What a pleasure to speak with you, and I look forward to your future articles.
Likewise, thanks.
Cheers.